Dear viewers, I hope you're having a good time. Do not forget to press the bell icon for the upcoming videos. Today we're going to talk about real versus nominal GDP. Economists use the rules that we described in the previous lecture, which values the economy's total output of goods and services. But is GDP a good measure of economic well-being? Consider once again the economy that produces, suppose, only apples and oranges. In this economy, GDP is the sum of the value of all the apples produced and the value of all the oranges produced. So that is, GDP equals to price of apples times quantity of apples produced in the economy plus price of oranges times the quantity of oranges produced in that economy. For simplicity, we are assuming that there are only two products that are being produced in the economy. Economists call the value of goods and services measured at current prices nominal GDP. Now notice that nominal GDP can increase either because price rise or because quantity rise. It is easy to see that GDP computed this way is not a good gauge of economic well-being. Why? Because this measure does not accurately reflect how well the economy can satisfy the demands of households, firms, and the government. If all prices doubled without any change in quantities, nominal GDP would double. Yet it would be misleading to say that economy's ability to satisfy demands has doubled, because the quantity of every good produced remains the same. So a better measure of economic well-being would tally the economy's output of goods and services without being influenced by the changes in prices. For this purpose, economists use real GDP, which is the value of goods and services, measured using a constant set of prices. That is, real GDP shows what would have happened to expenditure on output if quantities had changed but prices had not. To see how real GDP is computed, imagine we wanted to compare output in 2009 with the output in subsequent years for our apple and orange economy. We could begin by choosing a set of prices called base year prices, such as the prices that prevailed in 2009. Goods and services are then added up using these base year prices to value the different goods in each year. So real GDP for 2009 would be 2009 prices of apples times 2009 quantities of apples plus 2009 prices of oranges times 2009 quantity of oranges. Similarly, the real GDP in 2010 would be 2009 price of apples times 2010 quantities of apples plus 2000 price of oranges times 2010 quantity of oranges. And real GDP in 2011 would be 2009 prices of apples times 2011 quantity of apples plus 2009 prices of oranges times 2011 quantity of oranges. So you can see that we have taken the prices of 2009 as a base year price, and the quantities, we are taking the quantities of respective years, but we are taking the price of only 2009 for each year. Here you can see that we have adjusted the prices. The quantities are not being multiplied with the prevalent price, because then we would not be able to measure if the economy has grown or declined. So we have computed the prices for all 3 years. Because the prices are held constant, real GDP varies from year to year only if the quantities produced vary. Because a society's ability to provide economic satisfaction for its members ultimately depends on the quantity of goods and services produced, real GDP provides a better measure of economic well-being than nominal GDP. We have 3 years 2008, 2009 and 2010. And we are going to compare GDP of these 3 years. For nominal GDP, you are going to multiply the quantity of each product with its respective price and then add them up. So for 2008, the nominal GDP is $200. For 2009, the nominal GDP is $600. And 2010, the nominal GDP is $1,200. Now let's talk about real GDP. For real GDP, we are taking 2008 as the base year. So that means we are going to consider the prices of 2008 for each year. Now here, you are going to multiply the quantity of products of each year with the price of 2008. For 2008, the real GDP is $200. For 2009, the real GDP is $350, and for 2010, the real GDP is $500. So if you compare the real GDP with the nominal GDP, we can see that for 2008, the GDP remains the same. For 2009, the real and nominal GDP, if you compare the real and nominal GDP, the nominal GDP is greater than the real GDP, and similarly for 2010 also, the nominal GDP is greater than the real GDP. Now why is that so? We can see it is because of the higher prices as compared to higher quantities that has increased nominal GDP, and because in real GDP we have adjusted inflation, we have taken constant prices that gives us a true picture of the economy. The table that you can see on your screen shows how to calculate real GDP, nominal GDP and the GDP deflator for a hypothetical economy that produces only hot dogs and hamburgers. Now what is GDP deflator? It is basically a measure of the price level. It is the ratio of nominal GDP to the real GDP times 100. It measures the current level of prices relative to the level of prices in the base year. So basically it is measuring inflation, and what is inflation? Inflation is the increase in the general price level of the economy. And if you want to calculate inflation rate, the formula for inflation rate is GDP deflator in year 2 minus GDP deflator in year 1 divided by GDP deflator in year 1 times 100. You get the inflation rate of year 2.